Hi student, welcome to another session of manifested online classes. I want us we wind up with the topic number 1 by looking on the last subtopic, which is subtopic number 9. And in this particular subtopic, you're going to look on something known as provisions, contingent asset and contingent liabilities, how they are recognized and also accounted for in accordance with the IAS 37, International Accounting Standard number 37. And that particular standard is 100% the same with another standard at the public sector accounting, that is IPSAS 19. So in this particular topic, you're going to define what is a provision, what is a contingent asset, what is a contingent liability, and equally what is a liability. So therefore, we can define those particular terms. We start by looking on definition of various terms. Definition of a term. So the first term we need to define here is basically what is a provision. And when we talk about a provision, we say that this is a liability of uncertain amount and also timing. What that means is that if, for example, the company has been sued or the company is sued in a court of law, and when the year is coming to an end, the ruling regarding that particular case has not been delivered, it means that once the ruling is made after the end of the financial year, the company may be required to pay some damages. And because the company is not 100% sure about the amount of damages it may be required to pay, and also the company is not sure when the ruling will be made, then we say that is a provision. What the company is expected to do in such a case, according to the prudence concept, is to create a provision, to set aside money from its profit, basically to take into account such damages the company may be required to pay in what? In future. So therefore, we can start by defining the term provision, and we say that this is a liability, of uncertain amount and timing. Is a liability of uncertain amount and timing. So the other term we also need to define here is a liability. So when we talk about a liability, we say that this is a financial obligation which is expected to result into outflow of resources. So whenever the company is required to pay for something, maybe the company has been sued in a court of law, the ruling has already been made, and basically the company is now required to pay some damages. That is a good example of what? Of a liability. So therefore, we say that a liability, this is what? This is a present obligation, obligation as a result of past events, as a result of a past event, and its settlement, will result to outflow of resources. So that's how we define the term liability. So the other term we need to define here is something known as a contingent liability. When we talk about a contingent liability, on the other hand, we say that this is a possible liability which may arise in the future, and basically we say that the occurrence of such a liability is not within the control of the entity. Now, what is a good example of a contingent liability? A good example of a contingent liability is a pending lawsuit. If the company has been sued in a court of law, that is a good example of a contingent liability, because the company in the future may be required to pay some damages once now the ruling has been made as far as that particular case is concerned, and we know that the ruling which will be delivered by the court, it is not within the control of the entity. So therefore, we can say that a contingent liability, this is a possible liability, a possible what? Liability, which or that may arise, from the past event, and whose occurrence, or basically we can say whose existence will be confirmed by occurrence or non-occurrence of an event and in this case we say that event is basically uncertain, an event which is uncertain and not within the control of the entity, not within a control of the entity. So that is basically how we define a contingent liability, So we are saying the key terms here is that this has to be a possible liability. A possible liability is a liability which may or may not arise in the future. And basically we are saying that it will be confirmed by occurrence or basically non-occurrence of an event, and that particular event is not within the control of the entity. So that's how we define a contingent liability. And then we have the other term we also need to define here, and that is a contingent asset. Contingent asset. So the definition of a contingent asset and a contingent liability is actually the same. So the only difference here we talk of, or we say that it is a possible asset. Well, as now this one we are saying is a possible what? Liability, and basically that may arise from an event and whose existence will be confirmed by occurrence or non-occurrence of certain what? Event, not within the control of the entity. So we can say yes, so that is the definition of a contingent asset. It is a possible asset. Basically, possible asset means that this is an asset which may or may not do what? Arise in the future, and you are saying it will be due to a past event, to an event which has already taken place in the past. And actually, we are saying that the occurrence of that particular asset will be confirmed by a certain event which is not within the control of what? Of the entity. So therefore, what you need to know as far as these two standards are concerned, IS 37, IPSAS 19, you must be in a position to define those particular four terms. You may come across a question whereby the examiner is requiring you to explain any of those particular four terms. One of the common questions which I've seen in the past is whereby the examiner is requiring you, for example, to distinguish between a provision and a liability. Or you may be required to define now what is a contingent asset and a contingent what? Liability. So then from there we can proceed and look on something called the recognition of a provision. Some of the conditions which need to be fulfilled for a provision to be what? To be recognized. And remember, in this case, we have said a provision is basically an amount of money which will be set aside from the company's profit to cater for a liability which is likely to arise in what? In the future. For example, if the company do have a contingent liability, the company has been sued in a court of law, but when the year is coming to an end, the ruling has not been delivered by the court, then we are saying that is a good example of what? Of a contingent liability. What now the company should do in accordance with the prudence concept is to set aside an amount of money to cater for damages which the company may be required to pay once the ruling has been what? Has been delivered. Another good example of a contingent liability here is what if as warranties given by the company, or just we can talk of an expired warranty. What is a warranty? Basically, these are like an assurance by the company that if some of the products which the company sell become defective, they have some problem, then the company will accept the responsibility of repairing those particular product. For example, if you buy something like a TV, or maybe something like a fridge, you may be told by the seller, or the seller can give you a warranty. So if that warranty has not expired when the year is coming to an end, then that is a contingent liability to the seller, because if that product become defective, if that TV or fridge become defective, then you are entitled to return it now to the seller, and the seller will have now to do what? To incur the cost of repairing such a product. That is a contingent liability, and therefore, in accordance with the prudence concept, then we are saying such a company should create a provision, should set aside some amount of money from its profit, maybe to cater for those particular expenses which should be incurred in terms of repairing those particular products which have already been sold and which have become defective. So therefore, let's look on something to do with recognition of a provision. So when should the company create a provision as far as the contingent liabilities are concerned? So here we have two conditions which must be met for a provision to be recognized, and therefore we say that a provision shall be recognized. A provision shall be recognized. When two conditions are met. Number one, an entity has a present obligation as a result of a past event. And number two, a reliable estimate. Estimate can be made. A reliable estimate can be made of the amount of obligation, and there will be outflow of resources. There will be outflow of what? Of resources to settle the obligation. To settle the obligation. So if those two conditions are met, that the company can be able to make a reliable estimate of the obligation, the company can be able to estimate the amount of the liability, and also there are chances that there will be outflow of resources, then a provision always must be what? Recognized. The company should recognize a liability. Sorry, not a liability, but rather a provision. And also we are saying that the entity has a present what? Obligation as a result of past events. So those are the two conditions which must be fulfilled for the company to be able to do what? To recognize a provision in accordance with IFRS 19 and also IAS 37. Then from there we can look on the accounting treatment of these two items, accounting treatment of contingent asset and contingent liabilities, accounting treatment of contingent assets and liabilities, contingent liabilities. So first of all, remember you have said that contingent asset and contingent liabilities, we have said that these are possible liabilities. These are a liability or even an asset which is likely to arise in the future. Now, and I think I've given good examples here. I've said when talk about, for example, a contingent liability, a good example is a pending lawsuit. If a company has been sued in a court of law, the ruling has not been delivered at the end of the year, that is a good example of what? Of a contingent liability. On the other hand, a contingent asset is something like a merger and acquisition. If a company expect to acquire another entity or to merge with another entity, such a company can account, or basically the expected result, the expected profit from the company to be acquired, then we can say is a good example of a contingent what? Is a good example of a contingent asset. Now, according to these two standard IS 37 IPSAS 19, contingent asset and contingent liabilities are not supposed to be recorded or are not supposed to be part of the financial statement which would be prepared. So mean that a contingent asset, contingent liability should not be reflected in the company's balance sheet or in the company statement of financial position. But if a company has a contingent liability or a contingent asset, that can only be disclosed as part of the notes. Can only be disclosed as part of what? Of the notes. So therefore, we can say that both a contingent assets and contingent liabilities should be disclosed as part of the note, as part of note 2 financial statement. They should be disclosed as part of the note. That means, i.e., they should not be included in company's statement of financial position. So both contingent asset and also contingent liabilities here, we are saying should not be included in the company statement of financial position, and therefore they should only be what? Should only be included as part of the note, or in other terms, they should be disclosed as part of the note now to the financial statement. So I think we can also look on examples of these, examples of contingent. Examples include number one, we have pending lawsuits, pending lawsuits. So pending lawsuits is basically a court case by all against the company, and when the year is coming to an end, that case or the ruling as far as that case is concerned has not been what? Delivered by the court. Another good example is pending warranties. So pending warranties, these are warranties given by the company or warranties given to the company, but now when the year is coming to an end, those warranties have not done what? Have not expired. So, and then from there we have what referred as a merger and acquisition. Merger and acquisition, that this only qualify to be a contingent asset, but these two pending lawsuits, pending warranties can either be a contingent asset or a contingent what? Liabilities, a contingent liability. So that basically what you need to know as far as this particular topic here is concerned. You should be in a position to define the four terms which you have defined there. You should be in a position to know some of the conditions which need to be fulfilled for the company to recognize what? A provision, and equally how are the contingent asset, contingent liabilities accounted for, and basically I've said they are only disclosed as part of the notes. They should not be included as part of the statement of financial what? Position. And also you must be in a position to give the various examples of what? Contingent asset and contingent what? Liability. So to wind up with that particular topic, I want to give some assignment from the past papers. Assignment. So we have these questions here. So the first question is from the sitting of December 2022. This is question number 1C. So that particular question was asking, or basically was requiring you distinguish between a provision and basically a contingent liability. So to distinguish, you just define what is a provision, what is a contingent liability. Roman 2, you are required to summarize the circumstances for recognition of a liability. Remember, we have looked on two circumstances there, or two conditions which need to be fulfilled for a provision to be recognized. And then the other part was requiring you to indicate the accounting treatment of contingent asset, contingent liability. In very simple terms, what was expected there is that you say both contingent asset and liabilities are not supposed to be included in the company statement of financial position, but should be disclosed as part of what? Of the notes. And by doing that, you get now your 2 marks there. So we also have another question here for November 2020. This is question 1A. And then we also have the other question here for August 2023, which is question 4 what? Question 4C. Question 4C. So these are some of the questions as far as that particular subtopic is concerned. So that brings us now to the end of subtopic number 9, and also to the end of topic number 1. See you in the next lesson as we started on topic number 2.